In today's video, I want to talk about what makes a great investor. I've been venture investing now for 14 years. Before that, I did a bunch of real estate investing. I bought a 44 unit apartment complex when I was 18 for 100 grand. So I've been investing for a long time, and I've been fortunate to learn from some of the best investors out there. And so I thought it would be interesting just to talk about some of the things I've learned. And stick around to the end because I'm going to talk about the thing that I think really differentiates good investors from truly the very best. So the first thing that I think makes for a great investor is their ability to think strategically. Now, what do I mean by that? So it's one of my favorite things to do is to just think and ponder about the strategy of businesses. If you think about business from an economics or economist viewpoint, they basically say all businesses are basically the same and there are no real profits and pretty much everybody's a commodity. And they use that as their foundation to build on for all economic theory. But the reality is we know that all businesses aren't the same. And the strategy of business is the ability to create something that's different, right? And maintain that difference over time. Let's say you were one of the very first companies to, I don't know, bring Chinese food to a market, right? Well, then you're unique and you're selling something that's different. But then all of a sudden, other people see your success and they start bringing more Chinese restaurants to your area, and you got to figure out something else that's unique. Great investors are able to identify businesses that are both unique and have the ability to maintain that uniqueness over time and keep others from copying them directly. And there's so many ways in which companies can do that, which I explore in some of my other videos, but great investors are able to see that and are able to differentiate between those companies that have something truly unique and those that are ultimately going to end up like a commodity and look like everybody else. The next thing is great investors are good at risk management. Now, risk management does not necessarily mean that you diversify all the time so that you have no risk. The reality is great investors understand risk and like risk. The difference is they're really good at kind of pricing that risk and understanding what that risk is and not taking risks that frankly just don't make sense, right? I'm not going to go and invest in a lemonade stand down the street. I'm not going to give him $1 million because the chances of that, the little girl turning her lemonade stand into the next Coca-Cola is pretty low likelihood, and I would just lose all $1 million, right? So there are certain risks that don't make sense. On the other hand, maybe there's somebody that has a ton of experience in the food and beverage space and they have a unique product and unique brand and all of those things, and then in that case it would make sense to give them $1 million because it's a lot lower risk. There's still a lot of risk there, but a lot lower risk. And those characteristics about their business could justify taking that risk. All right, the next thing is that I found is that great investors have high levels of emotional intelligence. Now, what is emotional intelligence? Emotional intelligence really is just your ability to better empathize with people. And it can be an incredibly valuable differentiator between good investors and great investors. The reason for that is because so many times society frames business as being cold and just, money grubbing, and that's all they care about. They don't really care about people. But the reality is good businesses really do care about people. And as an investor, you need to put yourself in the shoes of that customer to really understand, is this company really solving their pain point? Not only that, but you need to be able to empathize with the entrepreneur, especially if you're investing in a company where your relationship with the entrepreneur will be pivotal to their and your success. Now, if you're investing in the public sphere, that's not as relevant. I think empathy and emotional intelligence still really matters, particularly if you want to become a professional investor and raise money from people, because in sales, emotional intelligence is just so important. And if you're going to raise money, you're basically selling people on your ability to manage and invest their money on their behalf. But even so, like I said, having empathy for the customer and understanding that can be really valuable. On the venture side and the private equity side, you're engaging a lot more with entrepreneurs. And in many cases, the very best entrepreneurs, they want to work with great people. I've had people tell me hey, this other investor has a great track record, but I really don't like the way that they treat other people, and I just don't want to do business with them. I don't care like how smart they are and how much value they think they can bring. At the end of the day, like I'm going to be kind of married to this person for the next 10 years. I want somebody I can trust. And an investor with high emotional intelligence is going to be able to demonstrate that trust and build that relationship. The next one I think is pretty obvious, but it's funny how often people lack it. And that is really good industry knowledge. Like you got to do your due diligence. You got to know the company and the industry that they operate and the competitors and so forth. You don't want to get blindsided because you don't know what you don't know because you didn't do the research to know it. I have found that like some of the best investors are some of the most brilliant when it comes to understanding a company and the industry they're in and the uniqueness that they have. I mean, for example, some of the best investors I know, they'll even go as far as saying like, I don't even invest in teams. I identify market trends. I do a ton of research on those markets and those industries. And from there, I pick out who's going to win in that industry. So understanding the industry becomes super, super valuable if you want to be a great investor. The next thing is I found that like great investors have a long-term mindset. They're less worried and stressed about like day-to-day fluctuations, and they're more concerned about the long run of their investments. And that can be both in terms of the actual investments they're making, but also their reputation and the impact that their reputation can have on their ability to do deals in the future. I'll give you a poignant example. So in venture capital, oftentimes what happens is you make a bunch of investments into these startups and they take a long time to grow. At least the successful ones do. The ones that are like not actually going to make it typically fail pretty quick. And so in the first few years, you just kind of feel like a failure because all of these companies that you invested in are failing. And the companies that are like ultimately going to do really well, like in many cases, like they're just doing okay, right? They're growing, steadily. And then you're faced with this choice, right? Like, where do you spend your time? Do you help the companies that are struggling, that are ultimately going to go to business? Do you help the ones that are going to be successful? And what I found is that really good investors that have this long-term mindset do two things really well. One, they spend time with companies that are struggling. They help them. They make introductions. They're there as a mentor and in some cases a therapist with the entrepreneur. They do what they can to help, but they don't necessarily invest in those companies. Instead, they save their capital for the companies that are doing really well, and they continue to support them, having that long-term mindset that if this company can continue to grow strong and steady over time, and we continue to put more and more money into it and double down in those investments, those will end up making so much more money that they will offset all of our losses. Doing this does a couple things that are super important. One, because you spend time helping and supporting the entrepreneurs that are struggling, you're able to build a really strong reputation among other entrepreneurs. You never know, a company that might fail could be started by an amazing founder who's just one or two startups away from their huge success. You want that founder to come back to you for every subsequent startup so you at least have the opportunity to decide if you want to invest. On the other hand, investing in your winners also allows you to generate great returns and also build your track record from a reputation perspective. So having that long-term vision and that long-term perspective can be incredibly valuable. I think you can take similar lessons and apply them to any type of investing, whether it's real estate or hedge funds or public market trading or debt or whatever it might be. Having that long-term vision in terms of how you're going to make investments can be incredibly valuable. I talked earlier about pricing risk. Now, pricing risk is really what valuation is all about. And so I want to take just a minute to talk about valuation. Now, there are a lot of different methodologies around valuation. In my mind, they really all boil down to two frameworks that matter. And even those two really kind of two sides of the same coin, we'll say. The first one is this idea of a discounted cash flow. And if you think about when you go to buy something, you are doing a discounted cash flow analysis in your head every time. So like, for example, I want to buy this marker. Well, when I go to buy this marker, it's going to have a price. But in my mind, I'm going to be thinking about like all the benefit that this marker is going to provide for me over time. Now, there are risks involved, right? I could lose it. It could get stolen. It could dry out. It may not be as good of a marker as the marketers purport it to be. But what I'm going to do is I'm going to take all of those future benefits and I'm going to add them up and I'm going to discount them based on the risks that I just outlined, and I'm going to come up with a price. And I'm going to look at that price that they're selling it for and I'm going to say, am I going to get more benefit from this than the price or less? If it's less, I don't buy it. If it's more, I buy it. If it's a lot more, I definitely buy it and I feel like I got a steal of a deal, right? Well, that's how companies are valued. The only difference is instead of like some benefit from being able to write things down, it's actually cash flow. And so you take those future cash flows, you discount them back to today relative to the risk and the purchasing power of that money, and it gives you a valuation. Great investors are really good at identifying the risks and then pricing them. And by pricing them, I mean like, what's the likelihood that my marker is going to run dry after the first time I use it? Probably not super high, but there is a risk there, right? Versus what's the risk that I lose it, or what's the risk that it breaks in half, right? So pricing all those different risks based on the probability of them occurring is frankly like a really hard thing to do. There's not like a mathematical way to do it. You just have to kind of use experience and knowledge about an industry and a sector and try to do the best guess you can. And good investors are really good at pricing that risk. Now, I said there were two things. So the other side of that coin is really this idea of probability, or asking yourself, what has to be true in order for this company to generate the kind of return that I would need in order to get excited about it. And then applying probabilities to all of those things that have to be true. So it might be like, well, I got to have a top tier, really great founder, right? I don't know in year one of backing this founder if they're going to be the next Jeff Bezos. It's like unknowable, right? But you can talk to them and you can pattern recognize relative to other founders you've worked with, and you can evaluate kind of like who they are and their core values. And your ability to evaluate a founder really well should give you an idea of like the probability that they could become the next Jeff Bezos, and then you apply a probability to that. You are essentially pricing that risk. Analyzing all of those things that have to be true, which means you have to understand the business, so you have to understand the industry, and then applying the probabilities allows you as an investor, especially if you're a good one, to come up with a valuation that makes sense. All right, so I said I would share the thing that I think really differentiates the good from the great. Now, good investors do a lot of these things, and they learn it, on the job, in business school, reading books, whatever it might be. But here's the thing that separates the good from the truly great. The truly great don't learn something specific in a book. The truly great investors have a secret. They have a secret that nobody else knows. And that secret is different for every great investor. That secret could be something like this one investor that I was just reading about that applies black swan methodologies, where he has comprised this investment strategy that takes advantage of black swan events. And he basically kind of loses money year after year after year after year. But then when there's a black swan event, he generates insane returns, 8,000% returns in the course of a day because of how he's built his model and his trading strategy. He has this secret, right? Some unique angle that he's identified that allows him to generate huge returns. And here's the thing, all great investors find at least one secret that differentiates them from everybody else, that allows them to take advantage of an opportunity. I'll tell you one of the secrets I had when I was 18. So I mentioned at the beginning of this video that when I was 18, I bought an apartment complex for $100,000. My secret was that in upstate New York, where I was living at the time, we had these tax auctions. The taxes in New York are really high, and so a lot of properties end up in these tax auctions. And so I spent a whole summer driving all over upstate New York looking at properties in these tax auctions. And I will tell you right now that the vast majority were horrible. Horrible, beaten down, ugly, just disasters of properties. Not the kind of thing you really wanted to be investing in. But because I was willing to travel all over the state, I stumbled upon this little town of Carthage. And in Carthage, there was an apartment complex that had gone into tax default. I went and checked out the whole thing, and when we went to go bid on it, the only other people that were there were people in the local community. And this was like several hours from where I lived, and it was kind of out in the middle of nowhere. The reason why this investment worked was because there was a new military base that was expanding nearby. And so we knew that we could get people from the military to stay in our apartment complex. And when we went to bid, there were no other real bidders because nobody else had done the legwork to find that property. It was our little secret. That effectively allowed us to buy what would ultimately be a multi-million-dollar property for about $100,000. One of the best investments I've ever made, and something that helped me pay for college and really get my feet underneath me early on in my career. So if you want to be truly great, you got to figure out what's your unique angle. You don't want to be a commodity investor. And by that, I mean, you don't want to be an investor that looks like everybody else. If you want to be truly great, you got to find your unique edge. Anyways, I hope this video is helpful to you. Check out some of my other videos, like how to start a private equity fund with no money. Thanks for joining.